This is Financial Literacy Month, and I want to challenge you with something right out of the gate. Most people think financial literacy means knowing more, understanding the markets, tax rules, investment strategies. But here's the problem. If knowledge alone worked, everyone with Google would be wealthy. We all know that's not true. So in this episode, we're going to flip the script. We're going to talk about what actually drives financial success. Not what you know, but how you behave, how you think, and why two people with the same information can end up in completely different financial situations. Hey, everybody, and welcome back. It's Financial Literacy Month, and it's one of those things where most people believe that money decisions are logical because money is real, it's math, 2 + 2 = 4, but unfortunately, it's not. There's a famous study you guys done by, and in fact, it won a Nobel Prize. It was done by an economist named Daniel Kahneman. I struggle to say his last name. But what he showed in that study is that humans don't make decisions rationally. We make them emotionally first, and then eventually we end up justifying them rationally. I always, when I think about this, one of the first things I always think about is cars, because if you know me, you know that I love cars, and cars are kind of a hobby for me. I know it's a bad financial decision, but I tend to trade cars quite a bit. And so over the years, my wife has gotten used to this. And so now every time I go to trade off of a car, the work I have to do is a little bit less than the previous time because I've done it so many times with my wife that she's just kind of now used to it. But early in our marriage, I always had to come to her with all these logical reasons of why it made sense for me to get a different car. But of course, I wanted a different car because emotionally I was primarily bored with the car that I had. I get very bored very quick. I put a lot of miles in cars. I sit in them in a long time. And so I emotionally always want a different one, but then I have to come to my wife and justify it to her logically. Now, as you guys know, it's very hard to justify logically or on a spreadsheet why you should be getting a different car because it's always going to be a financial negative. But Daniel Kahneman is absolutely right. We see this everywhere, not just in me trying to sell my wife on getting a new car every 18 to 24 months, but we see it when the markets go down and how people react. Same market downturn, but people react differently. We see it in headlines and how people read headlines and how they react to that. We see it in information. One person can read information on the internet or wherever they get that information and react to it one way, and somebody else can react to it a completely different way. You get one person that panics and sells, another one that actually wants to buy more. And why is that? Why is it that with information, we react completely differently? It's because money is shaped by your upbringing. Number one, it's shaped by your past wins and losses, and it's shaped by what you saw your parents do. Said differently, it's shaped by your lived experiences in life. I'm one of those people that was raised with not a lot. My parents divorced when I was young, lived with my mom, single mom, 3 kids, didn't have a lot. And there's multiple things that still stick with me to this day. As I get older, when you get out of college, everybody's broke, right? And then you start to have kids and then you're really broke. Well, now that I'm in my mid 40s, we actually have a little bit of discretionary income for the first time in our lives, which is great, but I'm still the guy to this day. I remember when I was young, I feel like body wash was invented when I was young. I think it was all soap before that, but more expensive and than soap was. And my mom allowed us to get body wash, but then got all over us about how fast it was disappearing. And so we had like this whole big thing in our house about how much was the appropriate amount of body wash to be using to put in your washcloth or your sponge or whatever it is that you're using in the shower. And so to this day, I'm that guy. I'm like very diligent about how much body wash I use, how much toothpaste I use, all these things. And I can't get rid of it because it's just the way that I was raised. Morgan Housel, in his book, The Psychology of Money, which if you've been around this podcast for any length of time, we've gone through that entire book. He says, people do crazy things with money, but no one is crazy. You guys ever thought about that? I talk about that with my wife all the time. You see other people doing other things and you're like, man, that person's weird. Why would they ever do that? My definition of weird is you wouldn't do it, which means everybody's weird in some respects. Even your best friends, even all of your family members, they're all weird. And we define weird as human beings as they react to things different or do things different than you would do. And Morgan just kind of points that out in the book. Everybody does weird things, but nobody's weird. He uses the word crazy because what he means is everyone's decisions make sense to them. It's based on their life experiences. So take a look back at the '08 financial crisis. I was a young, fairly newly minted financial advisor. Late 2006 is when I got into this industry. And then, of course, 2008 happens, which if you go back, it actually started at the end of 2007. So I was maybe 12 months into my career. But if you guys remember, the market dipped over 50%, peak to trough, 53% to be specific. Millions of investors, you guys, sold at almost the bottom, like the worst possible time. And a lot of them actually never got reinvested. So Dalbar is a long-term, did this long-term investor behavior study, and it's really interesting. And what they showed is the average investor underperforms the market by 3 to 5% a year annually. You guys, that's not because of bad decisions, and it's not because they're out buying different mutual funds and ETFs and individual stocks than all of their peers. It has to do with bad decisions, and those bad decisions are completely based on emotions and the way you feel when things are going on. You guys, it's not an intelligence problem. Said differently, one of the things that Matt and I, when we started this podcast together, and he used to be the co-host, that we loved to talk about was this, that there's no lack of information out there. All of you who are listening to this podcast could go out to the internet right now, go out to AI, ChatGPT, Claude, or whatever it is that you're using, and gather all the information that you could ever want, plus exponentially more than you ever need. It's not an intelligence problem. It's not an information problem. It's a behavior problem. So it comes down to this knowing versus doing. Financial Literacy Month, it's not about information. The reality is most people already know what to do. And maybe not in every situation. Maybe there are things, as it relates to specific tax, planning issues or certain parts of the market that maybe are a little confusing or whatever it may be. But at the 50,000 foot view, we all know we should save money. We all know we shouldn't panic. We all know we should invest for the long term. That's not new information. So why does this happen? It happens because knowledge doesn't show up when emotions spike. When you become very emotional, the knowledge tends to go away. The thing I always think about when I hear this is the supermarket, or when you're hungry and you get really hungry, and let's just say you're the person you're generally a pretty healthy eater. Maybe you're even on a diet or something like that, and you're trying to watch your calories, or maybe you're trying to watch your sugar intake or whatever it may be. But then you get really hungry and you get really emotional. It's scientific. That's not an opinion. And then so you start to make bad decisions. They always say that old adage, don't go to the grocery store hungry, because then you're just going to come home and look at all your grocery bags and be like, what was I doing? Why do I have 4 packages of Oreos? I was always told that you're supposed to shop around the edges of the grocery store, never go to the middle of the grocery store. But that's what happens when emotions spike. There's also another famous study out there that Harvard did. So if you want to believe Dalbar, if you've never heard about Dalbar, Harvard did a study on behavioral finance, and what they showed was that people's financial decisions are heavily influenced by something they call loss aversion. You guys, basically what that means is losses feel 2 times as painful as gains feel good. And so we're so much more adverse to loss than we are positive to the gain side of things, that we react and make weird decisions. So people sell when markets drop. People chase returns when markets are high. You guys, that's not logic. It's wiring. It's the way that we're wired as human beings. And it's not just financial. It's in every aspect of our lives. Like I brought up before, it could be something as simple as the way that you treat something like body wash or toothpaste that isn't going to make any long-term financial impact in my life, but it just is who I am. So to tie a bow on that, financial literacy isn't about knowing more. It's about building systems in your life and building plans so that you do not have to rely on emotions. It's also about having somebody in your life that isn't emotional the way that you are about your own money. Something I tell a lot of the fiat clients when I have the opportunity to is that I have a financial advisor. And it's not because I lack knowledge. This is what I do for a living. I would argue, and I don't mean this with any ego or hubris, I probably know more than most, which makes sense because this is my job. But what I also know is it's impossible for me to disconnect my emotions from my money, from my wealth, from my own situation. And so because of that, I really value that objective opinion, and to have somebody that can look on the outside in without the same emotion to my own money that I have, and make sure that I'm not doing exactly what I would tell my clients not to do, because I have all the information. What I can't do is detach my emotional competency from my own pile of money. So when it comes to that, and we think about like, what do you do with this information? How do I actually take this forward? Is there anything that I can do from a financial literacy perspective to put myself in the driver's seat, to make sure that I put myself in the best possible place moving forward? And the answer is simple. Number one, I would argue, and of course I'm biased because I'm in this industry, you should have a coach. You know, as I record this, it's actually the first day of the Masters. I know it's not the day that the episode's going to come out, but as I record it, I just got to say this is like a national holiday to me. I love the Masters. If you love golf, hate golf, I don't, it doesn't really matter. But the bottom line is golf, as we all know, is an individual sport. You're out there by yourself. Now, yes, you get a caddy to carry your bag, and yes, the caddy is kind of helping make some decisions on which club should be picked and things of that nature. But the work to become a professional golfer, the work to actually be competitive out there, between the stakes, as they say in golf, on Masters weekend, doesn't happen that day. It's all the work that was put in before that, and that work with the best golfers in the world. These are the people that, if relating back to your financial life, have all of the information. They have all of it. Every professional golfer would be able to tell every single one of us the exact perfect way to swing a club, the exact perfect way to hit a draw or to hit a fade or hit a flop shot, or if you're 5 feet off of a green that's got, whatever undulation and what type of shot to hit. They know all of that. Yet, interestingly enough, they all still have coaches. Why? Why would Tiger Woods have a coach? Why would Rory McIlroy have a coach? Why would the number one golfer in the world right now, Scottie Scheffler, have a coach? Because they can't be objective about their own situation. They can't watch themselves swing over and over again live while they're getting it done. So number one, from a financial literacy perspective, I think it's always good to have an outside opinion. And I take my own advice. Like I said before, still have a financial advisor for all the reasons that I laid out before, and also because I have a wife. It's much easier to have somebody else tell my wife what we should be doing with our money than it is for me to tell her what we should be doing. I'm sure all of you married couples out there can relate to that. You tell your spouse something 4 or 5 times and they don't listen, and then somebody else comes into the situation, gives them the exact same piece of advice, and they're like, "Oh, that's actually really good advice. We should probably be doing that." So it brings a little help to the situation there for me as well. But I would say number one, it's understanding that outside advice, when you think about financial advisors and the value of an advisor, it's not necessarily us helping you time markets or pick the right stock. It's this emotional piece to it. Financial literacy doesn't begin and end with knowledge. It's the understanding that you're an emotional creature and that you need somebody to help in those situations where emotions start to take over. The other place where I think we can add value is in learning how to spend your money. We talk a lot about this in this podcast and a lot of the episodes, but it's worth bringing up here a little bit as well. Because if you think about behavior and me kind of pushing on this idea that it's our behavior and our emotions that drive a lot of this for us, we build habits over time. And so if you've built the habit that you make your bed every single day, or you've built the habit that you go for walks every single morning, or you've built the habit that on Fridays you and your spouse go out for, pizza and wine or something like that, and you've kind of built these into your lives, and then all of a sudden you hit a point in life where somebody tells you to do the exact opposite. Stop doing that. Not only should you not do that, you should do something that's the opposite of that. It's really, really hard to do in any area of life. And financially, that's also true. And if you think about it, there are kind of two phases of life where the right thing to do for the better part of 30, 40, 50 years is to save money and to live below your means. And then you get to retirement, and all of a sudden you have to be a spender. In order for you to live the life you probably want to live, every year you were putting away money and you just watch the account balance go up, 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 and up. And now all of a sudden you have to become a person that takes that money and puts it back into your life. It's really hard to do. If you don't believe me, just think about the last time in your life you had to pull money out of your savings account. Not your brokerage account, not your retirement accounts. I didn't mean anything like that. Just literally your savings account. Because let's just say you're the person that saves $100 or $500 or $1,000 or $10,000 a month into your savings account, and it just grows and grows. And then all of a sudden life happens, something, breaks, or your car breaks down, or you need new HVAC or whatever it may be, or your kid needs a little bit of help and you have to go pull $1,000 or $5,000 or $10,000 out of your savings to make it happen. It's painful. It's really painful to do. Now convince yourself to do it every single month to fund your lifestyle. Extremely hard to do. And we deal with it all the time. The last thing I want to say to this, and kind of the third point of how to combat emotions, is just to have a plan. And I know that sounds super simple, and it is simple in concept. It's very, very hard in execution. It's been my experience that the people that just kind of aimlessly or willy-nilly, or even like have half of a plan, but there's no like real detail put into it, as they float around life, unfortunately, emotions tend to win because you don't have the logic to go back to. You don't have the plan to go back to. You don't have this recentering, bring me back to a non-emotional state, situation, or opportunity. If we can define what true north looks like for your family, whether that's cash flow related, whether that's your investment portfolio and investment philosophy related, that's tax related, it's your estate plan and kind of the legacy that you're looking to leave, or insurances that you have, whatever it may be, any kind of these areas of your financial life. If there isn't kind of a true north that's defined, when things get emotional, it's really hard to know if you're okay. And so that's where people tend to make bad decisions. Funny enough, I'm in my 20th year in this industry, and the joke for me with my peers has been, since I was about 7 months in, pretty green, we should take the chairs that are in our offices that we meet with clients in and replace them with like a Chase lounge, because I feel like a psychiatrist or like a counselor, and trying to counsel our families through a lot of these situations. I always thought when I got into this industry, it was all going to be numbers. I'm just going to show them numbers and it's all going to be fine because we're going to live and die by spreadsheets. And what I've realized is, when you're emotional, the spreadsheet doesn't matter. But when you're emotional, we need to have something to come back to. We need to have kind of a recentering. And that is where having a plan matters. Because if we know a year from now, 5 years from now, 10 years from now, the goals and objectives we have as a family, whether that's, again, what you want your monthly budgets to look like, to bigger picture things like what you want your hobbies and travels to look like, or saving for other particular goals to look like, or your end of life to look like, or your health care to look like, we can recenter on that and say, hey, are we still tracking? We're in the middle of a pretty volatile time in the market right now. We've had a handful of clients call and say, hey, am I okay? Like, am I good? Do we need to make any changes right now? And the answers always come back to the plan. It's like, well, let's just check the plan. And if we're still, if the plan still works based on where things are at in the micro, if in the macro everything is still tracking, then we get to take all the white noise that is the day-to-day, the white noise that is social media, that is the news headlines, that is the fluctuations of the market, and we get to kind of ignore them, essentially. But if we don't know how the short term or the micro affects the long term or the macro, the emotions tend to not only not go away, they tend to explode. And that's where people tend to make bad decisions. And so luckily for us, you could say, or because we purposely built plans, the answer in this short-term volatility to every client that is called, at least that I know of, has been, yeah, we're fine. You know why? Because we planned on this happening. Not specifically the war with Iran, or not specifically the days the markets goes up or the days that they go down, but we planned on bad things happening, and we built in a margin of safety that gets us around it. And so bottom line is, you have to have a plan. Have an objective outside opinion. Have a coach, right? There's nobody that's out there that's above a coach, myself included. That's my opinion. Step number one, make sure you've got a coach, and a coach that you can trust, and somebody that understands the emotional capacity that goes into financial planning, not just the spreadsheet side of things. Number two, if you are that retiree, make sure that they have this expertise in distribution planning like we talked about it. And number three, make sure that it's built on planning not just on rate of return. It's Financial Literacy Month, like I talked about at the beginning. And I just want to reiterate this, kind of shut down this episode, because we're actually going to do 2 episodes on this. And so I'm going to tease the next episode a little bit and say that we're going to dive a little bit deeper into this. But here's the bottom line. Like I said in the beginning, you guys, it's not about having all of the answers. It's about understanding how you make decisions. It's about building a plan that protects you from yourself. Because let's be honest, myself included, chiefest of sinners here. What's interesting is the more you know, the more dangerous it can be. So I'm the guy that's probably the most dangerous in the room, or one of the most dangerous in the room, because with more information, we think we can remove emotion from situations because I have the information. But unfortunately, you guys, that's not how emotions work. That's not how the human brain is wired. In fact, it's been my experience that some people, some of the most knowledgeable people, are the ones that tend to get the most emotional. And then the last piece of that is consistently doing the right things over time. We've all read the Aesop's Fables books when we were growing up, and we all know the tortoise and the hare. It's really, really, really hard to be the tortoise when the hare is running circles around us in the short term. But we all know how that story ends. The truth is, the biggest risk in your financial life isn't the market, it's behavior. And when people who win with money long-term, well, let me say that a little bit differently. The people who win with money long-term aren't necessarily the smartest people in the room from a spreadsheet perspective. They're the people that have plans. They're the people that have coaches. And they're the people that make the right decision, just the next right decision over time, and put those right decisions together over, it could be years, it could be decades. But we work with a lot of first-generation wealth. We work with a lot of people that worked very, very hard. And when you look at where they stand from these successful people from that perspective, it's those people that kind of put their head down, made the next right step, and continued to do it over and over and over again. That being said, that's what we're here for at Fiat. Isn't necessarily to bring even more spreadsheet knowledge to the table, although sometimes that is the case. We're here to be that guide. We're here to be that coach, and to make sure that there's a plan in place so that when the big bad wolf comes, that the house is going to withstand. Because it's not a matter of if, it's just a matter of when, and we want to make sure that we've got a path forward for that. With that being said, I love that there's a month dedicated to this. I love that we're trying to get, from a country perspective, people to focus in on their day-to-day overall financial lives. I just think that we need to focus more on the behavioral side of things than we do on the spreadsheet side of things. And so thanks for joining us for this episode of Retirement Redefined. We're going to be back in a couple of weeks, and we're going to dive into this topic even a little bit further. But until then, enjoy the rest of your day, and we'll see you in a couple of weeks.